Hi, Jerry.
Hi, Kim. How are you today?
I'm good, good. How about you?
Very good, thanks.
Good. Thank you for joining me today, for another episode of the Kim and Jerry podcast. And wanted to really talk about something probably a little bit more serious than we have in the past on our podcast. Because, we're getting a lot of inquiries now. People are finding, uh, they want to figure out how to safely invest. um, they want to be more engaged with their financial planners. Uh, and so I think that maybe some of the information that we could share about notes and their role in the portfolio and how they can stabilize portfolios might help with some of their discussions. Um, anyway, I'm going around the bush, but thank you for being here. Thank you for joining the Kim and Jerry podcast. And no, we're not financial planners. We're not financial analysts or advisors. We're not attorneys. We're not CPAs, doctors, and everything else, right? But we are here to share information that we know, that we feel that we're the expert in when we do our real estate investing and mortgage notes, and why we build portfolios for ourselves, right? How it has really been a strength in understanding how the notes can definitely create stability in portfolios. So with that, I'm going to let you go ahead and do your thing. I know that you're very well versed in this area, and your experience and your background brings a wealth of knowledge that I think everyone can benefit from. So what are your thoughts about this topic today?
First, I'm going to say again, I'm not a financial planner, I'm not an accountant, I'm not a lawyer,
Okay.
um, and I'm not a financial advisor. I'm going to talk to you today from the perspective of the experience that I have and the knowledge that I have on investments and portfolio analysis, portfolio management. Um, because I do have a little, well, more than a little bit of experience
And talk
managing
about
portfolio.
that a little bit, because I think that's important for just really understanding your personal relationship with notes and in portfolios, and what you have done in the past. So
Yeah,
want to give some
so
insight on that?
some of this comes from experience that I have on the investment committee for a fairly large publicly traded or public pension plan. Um, and, we spend a lot of time on the numbers, looking at various investments. What stocks do you buy? What bonds do you buy? What alternative assets and so forth. And as well as what I got from some of my corporate jobs in finance, and from my education in finance as well. So it's kind of a culmination
You
of all
breezed right over that. Your education in finance and is
from work.
from what? So you also have strong relations with people in this same arena, right? Where you
Yeah,
share your information with each other in regards to this subject matter on a regular basis, right? That keeps
true,
us all very current on what we're doing and how to go about it. So
true.
I think that, for those who are listening and trying to really figure it out, I think these are strong facts to present to our viewers and listeners. So, okay, I'll stay out of it. Go ahead.
Okay, so I know. Ask questions.
Okay.
Typically, what people will hear when they're talking about building an investment portfolio, portfolio for long term, for retirement and so forth, they'll be given some numbers. And whether it's a retail investor or whether it's a big corporation or a pension plan, you all start with the same set of numbers. You look at how much debt and how much equity do you put in your portfolio. Typically, for a retail investor, they'll say 30% debt, 70% equity, or something along those lines when you're young. And then over time, as you get closer to retirement age, you move out of the equities and into more debt. So maybe 80% equities, 20% debt, um, something along those lines. Typically, people, when they're thinking about building their portfolios, they think about bonds, they think about stocks, they think about electronically traded funds, things of that, or excuse me, exchange traded funds, things of that sort, because that's what's available for your typical retail investor. More recently, and I've forgotten when this really kind of started, when it took off, the portfolio theory world, those the guys that sit around in the Ivy Towers and they come up with this stuff, started saying maybe 30% debt, 60% equities, and 10% alternatives. So alternative assets, alternative investment classes. And the reason is when you start looking at a portfolio and you look at it over time, we know that historically the stock market grows at, 10, 15%. And really they're looking at the indexes, the Dow Jones Industrial, Standard & Poor's, and all those kinds of things. And over time, it grows at about 15%. If you look at individual stocks, it doesn't work that way.
Yeah.
And what you will find in with most portfolios is that they do look at individual stocks, individual bonds, and these things are moving up and down like this all the time.
Right. Right.
The problem you have is that the ups are great. Like right now, the stock market's up, 10, 15, 20, 30%. The
Right.
downs are really bad. The downs can be devastating. The
Yeah.
downs are bad for retail customers, and frankly, the downs are bad for big public pensions. It wasn't uncommon for us, to have the pension plan to shrink by $100 million. And, so what, you sit back and, well, it's big. Whether it's the state of California, whether it's, the state of Maryland, city of Baltimore, city of Philadelphia, you got to come up with that difference. So that's why people started looking at alternatives as a way to be able to dampen out some of the volatility. So the volatility is caused by, all kinds of external factors that have nothing, that don't always have a correlation to what you were expecting with your portfolio. So anyway, that's all the boring stuff. Trying to, without getting too deep into, the numbers and the analysis. So anyway, alternative investments were things that were developed to be able to help your portfolio withstand some of the vagaries of the stock market, of the bond markets, which are exchange traded. So the idea was you're looking for things that will reduce the volatility. So you won't get well, I got 30% return on this stock, but you also don't get, I lost 25% of my portfolio. And it took me 10 years to get that 25%. So it also is something, you use the alternatives to increase your returns. So typically with a debt instrument, you have a fairly low return, but it's solid, it's steady, it's always going to be there.
Right.
So you want to do some things that will increase your returns, but also not increase your volatility dramatically.
Okay.
You want things that are countercyclical. And, as the financial planners will say, that are not highly correlated to the other things that you have in your portfolio, that aren't correlated to the stock market, that aren't correlated to interest rates and things of that sort. You want something that's a longer cycle. Typically when you're investing for retirement, you're not investing expecting to get a huge return today because you're looking for this money 10 years from now, 20 years from now, 30 years from now, 40 years from now, whatever it is. So you're looking for something that's a longer cycle that will continue to drive your income over a long period of time to build that nest egg that you're looking for when you retire. You're looking for things that are inflation hedges so that when inflation takes off, you're not as affected. Then finally, you're looking for things that aren't affected by external environmental impacts.
Right.
Who's elected a president? What is the Fed doing with interest rates? Are we going into a recession or not? those are things that you want to try to be able to hedge against. So that's why people started putting in alternative assets. Some of the folks that are going, you got a question?
No, to your point though, we're in a climate right now where, there's a possibility of a change of administration or even some of the unknowns of even understanding, the whole season, right? And people are really trying to figure it out, and, I when I say figure it out, like, not just for themselves, but, when speaking with their financial planners, right? What is the right answer? What is the right term? What can they count on? Because, you know, there were things that they didn't expect, people didn't expect, investors didn't expect that caused such a loss. COVID was 4 years ago, but people talk about it as if it was last year. Like it's still having its ramifications
Yeah,
of the existence and the impact that it had on everyone's portfolio, right? And
yeah,
so those that were not, you know, invested in alternative assets such as mortgage notes, because that withstood that test of time, right?
yeah,
Um, so what do you do? And I think that everybody's trying to get prepared for an anticipated moment. When you started talking about the different things, the outside factors that
yeah.
could affect the portfolio.
So that's true, Kim. And that's, again, building the case for we want alternative investments.
Right.
And like I said, it's a, I'm not going to say it's a new thing, but it's something that is growing. Yeah, I mentioned earlier, people are, I've said 10% of your portfolio should be in alternatives. Um, when I was looking at the pension fund, I think we were at 15%, something like that. Um, and the reason was we had to do something to stop the volatility or to reduce the volatility. You can't stop it, but you kind of dampen it out to reduce it. Um, for as we talk about alternatives, for your big investors, like I said, the insurance companies, the pension plans, family offices, they have a lot of alternative assets that they can look at. They can look at venture capital, they can look at commodities, and retail investors can also get into commodities. They can get into gold and silver and things of that sort. Um, the bigger investors start get into other things as well as the traditional precious metals. Um, they can do real estate, they can do land, and frankly, we had trees. It's like, well, what's the value of
That's another
a cherry tree forest in Vermont? I don't know, but we had it in the portfolio.
thing.
So
Okay.
it was an alternative asset. Um, but I digress. So those are things that can fall into the category of alternatives. Mortgage notes fall into that category as well. And some of the reasons why it falls into that category, I'll go back to, what are you using an alternative asset for? One of the things is to reduce your volatility. Because it is not a exchange traded vehicle, but it is traded. You don't have the wild swings in price. We buy notes, and when we buy them, it may take us 3 weeks to close. In the time period between when we submitted our bid and when we closed, it's not like anybody's worried about the price is going to change. The price is the price. There may be some tweaking, but there's not going to be some wild swing because something happened in the economy. So it is less volatile. It's also tied to a long-term asset. It's tied to real property. And the value of the note is typically not going to fall substantially below the value of the real property. So as long as there's equity in the house or equity in the office building or factory, whatever it is, you're going to have your investment is going to be less volatile, and relatively secure. The other thing about notes, I talked about cycle, long cycle. The returns are constant. You know when you buy the note what you are going to get 5 years, 10 years, 15, 20, 30 years every month on that note. So it's not like I'm going out and I'm trying to get something really quick for this quarter or this year. I know when I buy this note, 20 years from now, I'm still going to be getting $500 a month.
Yeah.
So that does not change. So long cycle, again, something that you use, another reason for why you have an alternative asset. It's an inflation hedge. The wild part about notes is the underlying asset will appreciate. So, the note doesn't change dramatically. The payment you get is the payment you get, but the underlying asset can change dramatically in a highly inflationary environment. So typically, what would happen if you had a debt instrument, the value of that instrument goes down. What happens with notes is that if your house price goes up a lot, people refinance because they
Yeah.
want the cash out.
They want the
So they
cash out of
pay
out of
off
the
the
property.
note. Yeah. So they pay off the note. And as a note holder, you wind up getting you get your investment back faster, but you also wind up getting your discount accelerated.
Mhm.
So there could be a bump in the value of what you've invested. And now that you have that, you can take that cash, buy another note in another asset, and keep it moving.
Right. Right.
So you don't have that worry about inflation because inflation actually helps with the underlying asset.
Right. Right. I
And
think that
we,
no, go ahead. I'll
yeah,
I'll
I
I'll
was going
bring
to
it
say,
up. That was, we were talking a lot about real estate.
yeah,
And, I think that some of the more recent connections that people have been able to make with mortgage notes, it's still real estate. It's just that your investment is in the paper, right?
yeah,
But
it's
that's the alternative in the
yeah,
paper, but it's still real estate. And people have been finding some source of comfort, right? Investing in real estate versus in, different assets on the exchange as a
yeah,
way of hedging, right?
yeah,
The type
yeah.
of inflation, things of that
So
nature. So
it's an alternative real estate investment vehicle. So
exactly, exactly.
about the mortgage notes, and I mentioned it earlier, economic issues. So, and it's not affected by elections, recessions, things of that sort. And Kim talked about COVID. I'll talk real specifically about COVID. One of the things that happened during the COVID um, pandemic,
Error.
whatever you want, yeah, the COVID time period, was that there was a moratorium on foreclosures.
Yeah,
What we found in the real estate business is that for the most part, most real estate investors did not feel COVID because folks that had mortgages kept paying. People that had, apartments or whatever, they kept paying. So we didn't
right,
feel it.
right,
But one of the things that did happen was those folks that were on the verge of foreclosure were having financial issues before COVID. All COVID did was push everything down the road. So during the COVID time period, there weren't a lot of foreclosures. Then when the moratoriums lifted, all of those folks that were already on the brink or in the process, those foreclosure cases started to come forward. So you'll hear today that, there's a spike in foreclosures. It really
yeah,
wasn't a spike. Well, I guess it was a spike because it went from zero to back almost to normal. And actually,
right,
it's still not normal. Right now, we're
yeah,
running about 0.45% of mortgages going into foreclosure. historically is a couple or 3%. So we're still
Right.
substantially below normal, but there is a surge because all of those folks that would have been done, 1 month, next month, so on, they all kind of piled up and they're kind of working their way through the system. So even COVID didn't really have a big impact on the note space.
And then there were programs that were implemented to help the homeowner continue to keep their homes current, right? So the investor also benefited from that as well. So
Mhm.
um, like you said, it was a season where when everything else was falling off the table, if you will, the mortgage note industry was doing great
Yeah,
and was
yeah,
able to stay stable and continue to strengthen the portfolios that were being impacted by the COVID era
yeah, yeah.
time frame. So, yeah,
So I say all of that. Um, you asked me, how do mortgage notes fit into your portfolio? You look at it as an alternative. You look at it as another tool, so to speak, in your portfolio. You may have debt instruments. You may have equity instruments. You may have electronically traded funds. You may have gold. You may have some silver. Um, you may have some real estate. This is another real estate alternative,
right,
and
right,
it it can underfloor your overall portfolio because that for the most part the capital that you put in is secure, and over time it's going to grow based on the payments that are paid into paying into that note.
right, right. It almost seems too good to be true, um, but it works out very well. And I just want to continue to enlighten our community and give them this kind of information so that they can build on it and feel more secure as they start to move into the whole investing of mortgage notes, and how they can also continue their relationship with their financial planners, their financial advisors, to be able to ensure that the diversification is in their portfolio, right?
Yeah,
For such a time
yeah,
of whenever such a time may happen, right?
sure.
The big anticipation. And I'm sure there's going to be all kinds of, movies that will follow after this year. But um, we like to be able to say that we are taking a part in helping people be able to be better prepared and equipped and feel more secure in their decision making in their investments. So, um, I don't think that it's boring. I think it's a topic that I think we can continue to talk about because it does help people. Sometimes it takes two or three times to hear it, right? To understand it, to be able to connect the dots and say, okay, now I see how this works, right? And it's not an either or, right? It's supposed to complement and support,
Yep,
right? Um, I thought this was great. Do you have anything more you want to share?
that's it.
Yeah,
That's my how do you build a portfolio? How do notes fit in your overall investment plan? I
yeah,
think obviously I think it's a very good investment vehicle. Personally, as I said earlier, I moved a lot of my assets, my personal assets, out of equities, out of debt, and put them into mortgage notes because it just kind of made sense for me. It generates income, pays the bills, that kind of thing, and that works. Um, Also, it's allowed me to grow my portfolio or grow my overall, my overall investment portfolio
right.
because of some of the other things that I've done with the notes.
It certainly has helped me. It's helped me rebuild, in
Mhm.
fact. You know, um, Retirement was not what I thought it was going to be. And so it has helped me rebuild my portfolio, help me with retirement. I feel far more secure um, than even before when I thought I was secure. um, and it was a discovery that I wish I had found sooner. We
Yeah.
can always say we wanted to find this sooner, but I'm glad I did stumble upon it and find it and implemented it and gird up my portfolio because it has made a big difference and it's
Okay.
still going to be continue to be proven. So
Yeah.
I also want to give a big plug because you do a live webinar, right?
Yes.
Questions and answers on LinkedIn.
Yeah.
Um, and you do it every other Thursday at 12 noon. It's an opportunity to, once you listen to what we talk about here on YouTube and on our podcast, that it may spark some questions in you that you may want to get answered. And Jerry is available live on LinkedIn every other Thursday
Wow.
afternoon at 12 noon Eastern that will address your questions and concerns and maybe even think about how you too can implement this in your portfolio. And so this Thursday, May 2nd, is that correct? At
Yep.
noon, and then you can go on every other Thursday from that point on to be part of the live to get questions and answers. It's a very open type of interchange with our community, our viewers, our listeners, and um, it's turned out to be a great platform to really get into the weeds, I think, as far as notes are concerned and how people are thinking about it and how people are trying to implement. And so the
Yeah.
invitation is open. Also, please visit our website, firstshieldfinancial.com. There's also an opportunity to, sit down with either myself or with Jerry or anyone else on our team if you want to ask questions or just kind of throw around some ideas. That's there available for you as well. And of course, our YouTube channel. Please subscribe. Please like. Please engage. If you have a question, I check the comments to make sure that I am addressing them. So, I welcome the comments or any other questions. And then we have an email you can always get on and ask questions too. So, um, we just hope that this is making sense and making everybody else feel more comfortable about investing in mortgage notes. Now, anything else, Jerry, you want to add?
That's it. I appreciate the time and hopefully have answered some questions about the note world and note investing.
Absolutely, you did. Absolutely, you did. I always appreciate you. Thank you so much. Until next time,
All right.
take
Bye
care.
bye. Take care.
Bye bye.